Hello aspirants, welcome back to India for IAS. This is Manjunath Mudho. Topic of this video is direct tax to GDP ratio. In this video, we are going to study about what is tax to GDP ratio, what is direct tax to GDP ratio, why direct tax to GDP ratio is in use, then a few data released by Central Board of Direct Taxes, then state-wise tax direct tax contribution, what is tax buoyancy, then other data released by CBDT, followed by prelims practice question. As per the data released by CBDT, for the financial year 2023, direct tax to GDP ratio rose to the 15-year high, whereas the tax buoyancy dipped. Before we move into direct tax to GDP ratio, first let us understand what is tax to GDP ratio. Mathematically, tax to GDP ratio is tax divided by GDP. So this ratio indicates nation's tax revenue related to the size of economy in terms of GDP. The ratio also indicates potential taxation related to the size of economy. This ratio also indicates that how government uses its economic resources via taxation. The ratio also helps us to understand the direction of a nation's tax policy. So it also enables for international comparison between different countries. Tax to GDP ratio also indicates the fiscal health of a nation. So if tax to GDP ratio is more, this indicates that the country is earning more in terms of taxation. So tax to GDP ratio, if it is less or if it is decreasing, then fiscal health of the country is deteriorating. According to the World Bank, tax to GDP ratio of 15% and above is necessary for economic growth and poverty reduction in any country. If tax to GDP ratio is less than 15%, then economic growth and poverty reduction cannot be achieved. An increase in tax to GDP ratio means higher tax revenue to the government. So the government can spend more on improving infrastructure, health, and education. So these are key for the country's long-term sustainable development. Before we move into direct tax to GDP ratio, first let us understand the difference between direct and indirect taxes. In direct tax, the incident and impact of the taxation is on same person, whereas in indirect tax, the incidence of the tax and impact is on different persons. Direct tax is on income or wealth of a person, whereas indirect tax is on goods or services enjoyed by the person. The burden of taxation is progressive in direct tax, as more income attracts more income tax. In case of indirect tax, the rate of tax is flat, so both rich and poor pay the same tax rates. It indicates that poor people end up paying more taxes compared to the rich people. Because of this regressive nature of the indirect tax, it is not considered to measure the fiscal health of a nation. Instead, direct tax is taken to measure the fiscal health. That's why we are going to study about direct tax to GDP ratio. Moving on to the other differences between direct and indirect tax. Tax evasion is possible in direct taxation. It is impossible or more difficult in indirect tax. So direct tax helps in reducing the inflation, whereas indirect tax contributes to the inflation. Then direct tax cannot be shifted to the others, whereas indirect tax can be shifted to others. So example for direct tax are income tax, wealth tax, capital gains tax, security transaction tax. Then for indirect tax, it is excise duty and GST. Now we will move into direct tax to GDP ratio. So direct tax is the tax levied directly on individuals or corporations based on their income or profits. So direct tax to GDP ratio, it indicates that the proportion of direct taxes collected by the government in relation to the gross domestic product. This direct tax to GDP ratio provides insights into the fiscal policy and revenue generation efforts of the government. So a higher direct tax to GDP ratio indicates larger government and potentially a greater role in the economy. Higher direct tax to GDP ratio indicates that government has a greater revenue for financing public services and infrastructure development. This also indicates that there is a stricter tax enforcement and there is a larger formal economy in the nation. So formal economy means economic activities that are legally recognized and regulated by the government. If the tax to GDP ratio is lower, it indicates that the economy is informal in nature. This also indicates that the tax rates are lower or the tax collection is inefficient in the system. Therefore, higher direct taxes to GDP ratio is viewed as progressive compared to the indirect taxes. Now we will move into the few data released by Central Board of Direct Taxes. So direct tax to GDP ratio reached 15-year high of 6.11% in the year 2022 and 23. and the number of income tax return filers also increased to 7.4 crore for the financial year 2023. That is 6.3% rise compared to the financial year 2022. Here the data is not important, the trend is important. Trend means whether it is increasing or decreasing. So this in UPSC the figure numbers, these figures will not be asked. What they are going to ask is whether it is increasing or whether it is decreasing. So this is very important from examination point of view. Then moving on to the state-wise direct tax contribution. So Maharashtra stands first in the direct tax contribution, that is around 36.4%. Again, this figure is not important. What is important? The sequence. So Maharashtra stands first, then Delhi, then Karnataka, then Tamil Nadu. So this sequence is very important. Now we will move into tax buoyancy. So what is tax buoyancy? What is the trend of tax buoyancy as per CBDT data? So what is the importance of tax buoyancy? Tax buoyancy explains the relationship between changes in the government's tax revenue with respect to the changes in GDP. If GDP is growing 8% every year, so what is the changes in growth rate of taxes, whether it is increasing or whether it is decreasing? So this relationship is explained by tax buoyancy. Tax buoyancy refers to the responsiveness of the tax revenue growth to the changes in the GDP. For example, as we have earlier discussed, if GDP is increasing 8% per annum, what is the response of the tax revenue growth with respect to the changes in GDP? And when a tax is buoyant, it indicates that revenue is increasing without increasing the tax rate. So without increasing the tax collection or tax revenue is increasing. So what is important here? Without increasing the tax rate. So this relationship between tax revenue and GDP, changes in the GDP, is called as tax buoyancy. Tax buoyancy greater than 1 indicates faster growth in taxes compared to the country's national income or GDP. So this tax buoyancy depends on following factors, that is tax base, then tax administration in the nation, and rationality and simplicity of the taxes in the nation. Then as per the data released by CBDT, there is a decline in tax buoyancy for the year 2022-23 compared to the year 2021 and 22. So the numbers are not important. What is important is trend, whether it is increasing or whether it is decreasing. For examination, trend is very important. And CBDT also mentioned that tax buoyancy had improved to 2.52 in 21-22 because of the low base effect. So what is base effect? Comment. Now we will move into the other data released by CBDT. So the first one is the number of individuals filing income tax returns is increasing. So the number of people or individuals who are filing ITR is increasing. It indicates that there is a rise in employment in India. Then the second data indicates that there is a gap between tax return filers and overall tax payers. So the overall tax payers are more, and the number of people who are filing tax returns is less. It indicates that more of the tax is deducted at TDS. Then the third data indicates that the direct tax collection constituted around 54.62% of the overall tax collections. So it is a 4-year high. So this is all about direct tax to GDP ratio, tax to GDP ratio, difference between direct and indirect tax, tax buoyancy. So these terms are very important from prelims perspective because UPSC previously asked questions based on these topics. So based on the topic that we have discussed so far, here we have provided one prelims practice question. Go through the question and comment your answers. UPSC in the year 2015 asked one question in prelims based on tax to GDP ratio. A decrease in tax to GDP ratio of a country indicates which of the following? Statement 1, slowing of economic growth rate. Statement 2, less equitable distribution of national income. So while studying tax to GDP ratio, nowhere we have studied less equitable distribution of national income with respect to tax to GDP ratio. So this indicates that statement 2 is incorrect. So we can infer that if there is a decrease in tax to GDP ratio, this definitely indicates that slowing of economic growth rate. So in this case, the answer is statement 1, that is 1 only. Option A is the answer. Thank you for watching. See you in the next video. Till then, happy learning.